So imagine a single, basically invisible software system that manages $3 trillion.
I mean, it's almost impossible to wrap your head around that number.
Right. It's not just a big number. That is a figure larger than the entire gross domestic product of France or the UK.
Yeah, completely massive.
You interact with the global financial system every single day, but today in this deep dive, we were looking at the company that actually built the plumbing hidden inside the walls of that system. We're talking about SS&C Technologies.
And their Q2 2026 earnings results, which they just put out in their official presentation and press release, give us this incredibly rare window into how that machinery actually operates on a global scale.
Exactly.
Yeah.
SS&C, they trade under the ticker SSNC, and they run this really specific hybrid model. It's software as a service mixed with technology-enabled services.
Right, primarily for these massive financial institutions and healthcare organizations. And because they're so deeply embedded in those industries, their financials tell us so much about the mechanics of scale and really monopolistic efficiency.
Yeah, and our mission today is to unpack exactly how that model allowed them to generate nearly $1.7 billion in a single quarter.
A single quarter. It's wild.
It is. We're going to look at which specific business units are carrying that weight, investigate a little bit of a contraction in their healthcare division, and decode what looks like a highly aggressive capital return strategy.
Because if you're a learner trying to understand how mature tech monopolies behave, how they allocate capital, and how they build competitive moats, this is the blueprint.
So true. And I feel like the best place to start is just right at the top line, because the sheer scale of the revenue generation kind of sets the stage for everything else.
Absolutely. The scale is staggering.
Yeah, so adjusted revenue for Q2 hit a record $1,696.9 million. That's up 10.3% year over year.
And the adjusted diluted earnings per share, the EPS, came in at a record $1.76, which is a jump of 18.1%.
But okay, the number that really jumps off the page for me, honestly, is their margin.
Oh, the EBITDA margin.
Yes. Adjusted consolidated EBITDA hit a record $670.7 million, which translates to a 39.5% margin.
Which is huge.
Right. When I see a margin pushing 40%, I immediately think of like the markup you'd expect on a high-end luxury watch or a designer handbag. I do not necessarily think of enterprise, B2B software, and back-office services.
Yeah, it feels out of place for that sector.
Exactly.
Yeah.
So my immediate thought is this has to be a temporary peak. Like gravity is eventually going to pull a margin that high back down to earth, right?
Well, gravity usually applies when the cost of delivering a service rises alongside the revenue it generates. But SS&C operates with what their CEO, Bill Stone, specifically called structural advantages in the release.
Okay, structural advantages, meaning what exactly?
Meaning that building the initial software infrastructure, to handle complex multi-jurisdictional hedge fund administration, that requires a massive upfront capital investment.
Sure.
But once that code is written and tested and deployed, the marginal cost to add the next client or process the next $1 billion is practically zero.
Oh, wow. So as their revenue scales up by that 10.3%, their underlying costs are just staying relatively flat.
Exactly. That extra revenue just waterfalls straight down to the bottom line. It's the defining engine of technology-enabled services.
Which explains why their adjusted earnings per share is growing at 18.1%. It's vastly outpacing the 10.3% revenue growth, right?
The efficiency is just baked into the model. They even expanded that EBITDA margin by 0.5 percentage point year over year.
Which, I mean, 0.5% might sound like a rounding error to some people.
Yeah, but at $1.7 billion in quarterly revenue, that slight tweak in efficiency creates millions in pure recurring profit.
Okay, I want to pivot and look at the gap between their adjusted numbers and their GAAP numbers because it is incredibly wide.
It really is.
Yeah, so their GAAP revenue was slightly lower at $1,695.7 million, but their GAAP earnings per share was only 97 cents.
Quite a drop from the $1.76 adjusted EPS.
Exactly. Now, that 97 cents is still a massive 34.7% jump from last year, but it's a far cry from the adjusted number. My hypothesis here, when I see a GAAP EPS that is nearly half the adjusted EPS, is that we're looking at the ghost of acquisitions past.
The ghost of acquisitions past, I like that.
Well, they buy a lot of companies, right?
Yeah.
So accounting rules force them to pretend the value of that acquired software is decaying every year, taking a bite out of their GAAP earnings, even though the software is actually generating cash. Am I reading that right?
You're capturing the exact mechanism at play. SS&C is a highly acquisitive company. Growth through acquisition is literally central to their strategy.
Right.
And standard GAAP accounting requires them to take non-cash expenses on those purchases, primarily the amortization of intangible assets.
So they're essentially forced to write down the value of the intellectual property and the client lists they purchased over time.
Exactly. Plus, they also have to factor in stock-based compensation and some complex purchase accounting adjustments.
But just to be clear for everyone, none of that amortization actually impacts the cash they're depositing in the bank today. Like it's a paper expense.
Mm-hmm. Which is why the market and the management team focus so heavily on the non-GAAP adjusted numbers.
Because it shows the real cash flow.
Right. Stripping away those accounting artifacts gives you a much clearer picture of the actual cash-generating power of their day-to-day operations. And those operations are highly lucrative.
So because that day-to-day cash generation is just humming along, the logical next step is to figure out exactly which segments are driving it.
Let's look at the segments.
We mentioned the 10.3% total adjusted revenue growth, but their adjusted organic revenue growth was 7.6%.
Right, stripping out the acquisitions.
Yeah, so that tells me that even if they completely pause their acquisition engine today, their core legacy business is still expanding at a really healthy clip.
Yeah, the organic growth reveals the underlying demand for their core platforms. And right now, that demand is being driven almost entirely by their financial technology segments.
Which one specifically?
So, Wealth and Investment Technologies, or WIT, was up an impressive 9.8%. Globop, which handles hedge fund and private markets administration, grew by 9.0%.
Wow, okay.
GIDS, that's their unit managing retirement and distribution solutions, was up 8.9%, and Intralinks posted a solid 7.4% growth.
So the financial side is just clearly thriving. But the entire board wasn't flashing green.
No, there were some soft spots.
Yeah, intelligent automation and analytics dropped by 1.0%, and healthcare fell 3.1%. I want to focus on that healthcare contraction for a second.
Sure.
With healthcare shrinking by 3.1%, I mean, is this a macro warning sign? Like, are healthcare tech budgets freezing up everywhere, or is it just noise for a company of this massive size?
Contextualizing the sheer size of these segments really answers that question. Healthcare revenue for Q2 was around $261 million.
Okay.
When you place that against a consolidated revenue base that's tracking toward $6.8 billion annually, it represents a very small slice of their overall pie.
Right, so it's a blip.
Basically. The slight contraction might point to longer sales cycles or, delayed IT spending within hospital systems right now. But because they are so deeply entrenched and dominant in financial services through Globop, GIDs, and WAT, the broader company is entirely insulated.
Got it. So the financial segments are just easily carrying the weight of a sluggish healthcare quarter. It really shows the value of having a diversified client base.
Yeah, they aren't held hostage by a single sector's capital expenditure constraints.
But honestly, the growth numbers weren't even the most shocking part of their core business health for me.
Oh, yeah. What was?
It was their revenue retention rate, 96.9% for Q2 2026.
It's incredible.
Almost 97% of their historical revenue is just locked in before they even attempt to make a new sale in a given quarter.
That retention rate is the ultimate holy grail for B2B enterprise software. I mean, a 96.9% retention rate means the pain and risk of canceling the service is significantly higher than the financial cost of simply renewing the contract year after year.
It really comes down to system integration, doesn't it? Like, if you are a massive financial institution, SS&C is not just an application sitting on your desktop.
No, definitely not.
It's your core accounting ledger, your trading infrastructure, your compliance reporting system. You can't just rip out your central nervous system on a Friday afternoon and hope a new vendor's software is working perfectly by Monday morning.
The operational risk is just too immense. The switching costs are astronomically high, both technically and financially.
It would be a nightmare.
Exactly. If a global bank wants to switch providers, they have to retrain thousands of staff members, migrate decades of sensitive financial data, and navigate these complex regulatory hurdles during the transition.
All without dropping a single transaction.
Right. For these clients, SS&C software is mission critical to their survival. So that 96.9% stickiness is not just an impressive metric on a slide deck. It's the foundational pillar of their entire financial profile. It creates intense revenue predictability.
And because that revenue is so incredibly predictable, Banks are perfectly happy to lend them billions, and management is free to be highly aggressive with how they allocate their cash.
Let's talk about that cash machine.
Yeah, let's look at it. Operating cash flow for the first 6 months of 2026 was $716.4 million. That is up over 11% from the previous year. And their strategy for utilizing that cash is basically just shoveling it directly back to the shareholders. In Q2 alone, they returned $499.2 million.
$500 million in a quarter.
Right. That breaks down to $64 million in dividends and a massive $435.2 million in share buybacks. They retired 6.4 million shares at an average price of $67.57.
And year to date, they have returned $733 million. Management explicitly pointed out in their presentation that this represents returning 100% of their allocated capital directly to shareholders.
Okay, wait. I have to challenge that 100% strategy.
Go for it.
If you are returning literally all of your allocated capital via buybacks and dividends, I mean, are they basically admitting they've run out of land to conquer? By buying back their own stock at this scale, are they signaling to the market that they just can't find any external companies worth acquiring or internal projects worth funding? Is it a lack of imagination or supreme confidence?
Well, it's a really good question, but it's a question of capital efficiency and internal hurdle rates. We really have to clarify how they define allocated capital in this specific context.
Okay, lay it out for us.
This cash flow is what remains available after they have already funded their internal research and development.
Oh, I see.
Yeah, they're still guiding for capital expenditures to be between 4.4 and 4.8% of revenue for the full year. So the business itself is still being actively invested in.
Okay, so they aren't just starving the core engine to buy back stock.
Not at all. What the buybacks indicate is a very strict internal valuation process. Management looks out at the landscape of potential buyout targets, they run the numbers, and then they look at their own stock trading at, $67.57.
And they decide it's a bargain.
Exactly. They're deciding that buying their own shares offers the lowest risk, highest return investment available to them right now.
Because they know the intricacies of their own business better than any external target.
Exactly.
They see that 97% retention rate, and they're putting a very public stake in the ground saying, hey, the intrinsic value of this company is materially higher than the current market price.
And there's a mechanical benefit, too.
Right. By retiring those 6.4 million shares, they are financially engineering future EPS growth. By shrinking the total number of shares outstanding, each remaining share gets a larger claim on the earnings.
Yeah, that mechanical benefit to the EPS is a major driver of the strategy. But, you can't really discuss this level of aggressive capital return without looking at the other side of the balance sheet.
The debt.
The debt. Gross debt currently sits at $7,613.5 million. And they have $434.8 million in cash on hand.
I mean, $7.6 billion in debt sounds terrifying on its face, especially while they're spending $500 million a quarter buying back stock. Like, why aren't they using that cash to aggressively pay down the principal?
It looks scary, but the leverage ratios tell a slightly different story than the raw number.
Okay, their net leverage ratio is 2.75 times, and their secured net leverage ratio is 1.70 times.
Right, and that distinction between total net leverage and secured net leverage is vital for understanding their risk profile.
So,
The 1.70 times secured ratio means the portion of their debt that is actually backed by hard assets is extremely low relative to their earnings. A 2.75 times total leverage ratio is considered highly manageable in the world of recurring enterprise software.
because the cash flow is practically guaranteed by the stickiness of the software.
Exactly. The debt is a deliberate feature of their historical acquisition strategy, not a bug.
Right, they acquire, they lever up, they integrate.
Yes. They acquire a company, take on debt to finance the purchase, and then integrate the new company into their highly efficient platform. The massive cash flow from the newly combined entity easily services the interest on that debt, while still leaving enough free cash left over to fund these massive shareholder returns.
It really is a very deliberate, mathematically sound financial engine.
It is.
So we've dissected the mechanics of the cash machine, but we have to talk about the sheer, mind-boggling scale of the assets powering it. Because looking forward, the most critical metric might just be the volume of assets they manage.
The AUA.
Yes, alternative assets under administration, or AUA, reached $3,060 billion in Q2 2026.
That's $3.06 trillion.
Trillion, with
Yeah.
a T. We're talking about the administration for hedge funds, private equity, and real estate funds. And that number has just been climbing steadily quarter after quarter.
It represents a massive concentration of global financial data flowing through a single company's infrastructure.
But wait, when your software is the backbone for over $3 trillion, does that sheer size make you immune to normal market competition? Or does it just make you a giant, slow-moving target?
What do you mean?
Well, you have these nimble, AI-driven fintech startups popping up constantly, right? They're promising faster interfaces, automated workflows, cheaper fees. Why don't they just eat SS&C's lunch?
In a highly regulated industry like alternative asset management, scale acts as an immune system, not a vulnerability.
An immune system. Okay, I like that.
Think about the risk profile of a massive private equity firm. A nimble startup might have a slicker dashboard or a more modern user interface, sure. But if you are managing tens of billions of dollars, your primary operational concerns are security, regulatory compliance across 50 different global jurisdictions, and absolute unwavering accuracy.
Yeah, nobody wants to be the beta tester for a startup's new AI tool when a single reporting error could trigger a massive SEC fine.
Or alienate a billion-dollar institutional client. The reputational and regulatory risks are simply too high for their clients to experiment.
That makes total sense.
At $3 trillion in scale, SS&C has encountered every obscure tax structure, every weird market fluctuation, and every complex compliance mandate imaginable. That deep institutional knowledge is hard-coded into the software itself. It creates a regulatory moat that makes it incredibly difficult for a new entrant to unseat them.
Which loops right back to that 97% retention rate we were talking about earlier.
It's a completely closed loop.
Yeah, the regulatory mode secures the recurring revenue secures the cash flow, and the cash flow funds the buybacks. And that loop gives them a lot of confidence when setting their forward-looking guidance.
Oh, for sure. Let's look at those guidance numbers.
For Q3 2026, they are guiding for adjusted revenues between $1,657 and $1,697 million, with adjusted EPS between $1.73 and $1.79. And then for the full year 2026, they expect adjusted revenues of $6.672 to $6.832 billion and an adjusted EPS of $6.93 and 25 cents.
There's a really fascinating technical note attached to that guidance in their earnings presentation, actually.
Oh, what is it?
SS&C explicitly relies on what the SEC calls the unreasonable efforts exception. They state they will not provide reconciliations of these forward-looking adjusted metrics back to GAAP measures.
Unreasonable efforts. That sounds like a very polite corporate way of saying, we don't want to do the math. What does that actually mean in practice for a public company?
It means the math is literally impossible to predict accurately without running the risk of totally misleading the market.
How so?
Well, to forecast exact GAAP numbers month in advance, SS&C would have to accurately predict global macroeconomics. They'd need to forecast exactly how foreign exchange rates will fluctuate across the globe, predict the exact timing, size, and integration costs of potential future acquisitions, and, anticipate specific non-cash adjustments tied to their debt covenants.
Ah, okay. Because they operate globally and acquire companies constantly, those variables are just entirely out of their day-to-day operational control.
Exactly. So instead of guessing and getting it wrong, they focus their forward guidance entirely on the adjusted operational metrics that they can actually control and forecast reliably.
It's a good reminder that underneath those clean, predictable top-line numbers is a sprawling, incredibly complex global operation.
Oh, absolutely.
So bringing this all together, SS&C's Q2 2026 results really are a masterclass in structural advantage. You have a core financial technology business driving solid organic growth. You have a retention rate that makes their revenue incredibly predictable.
Unshakable, almost.
Right, and you have a nearly 40% EBITDA margin that just spins off hundreds of millions in free cash that they are aggressively funneling right back to their shareholders.
And as you digest these numbers, consider the broader implications of what this company actually does. We spend a lot of time analyzing revenues, margins, and software as a service models. But when a single entity provides the administrative backbone for over $3 trillion in alternative assets and retains 97% of those clients year after year, the paradigm kind of shifts.
Yeah, it does.
At what point do we stop viewing them merely as a B2B technology vendor and start recognizing them as a systemic, irreplaceable pillar of the global financial plumbing?
Wow. Yeah, if they're the invisible pipes of the financial system, you definitely want to know when the pressure is rising and the flow is expanding. Right now, the flow is massive. It really changes how you look at the unseen infrastructure powering the markets. Thanks for taking this deep dive with us, and we will see you on the next one.